Alright, so by using the strategy of constant dollar averaging, we can see that having a good discipline actually will make you a lucky investor, where you can make a profit in the market if you are consistent in your investment. Alright, now we are going to look at the analysis, which investment actually better. Alright, so we have to, this is actually quite a long explanation on how we can conduct an analysis whether fund A or fund B, which one is actually better, perform one another, and how we should make a decision in understanding which investment is actually good for our client in the long run. Alright, now we are going to look at the example for Fund A and Fund B, where we are going to look at the impact of dollar cost averaging on the investment return. As for Fund A, we can see here the information on the year, that is year 1, year 2, year 3, and year 4. I mean that this is the information about the schedule of net asset value, NAV changes for Fund A for the 4 years period. And the beginning net asset value is 1 ringgit, and the ending for the first year is 1.5. And if you look at these changes from 1 ringgit to 1.5, okay, 1 ringgit and 50 cent, this is actually an increase by 50%. Okay, so the percent of change is 50%, and it is positive because it is an increase. In the second year, the beginning NAV is actually based on the ending NAV. Okay, ending NAV here become the beginning NAV, and the ending NAV for the second year, we can see that the beginning is 1 ringgit and 50 cent, now reduced to 1 ringgit. And this is actually a reduction of 33.33%, and it is negative because it's a reduction. So this is how actually you are going to read this table, and this is for the third year, and this is the fourth year, and the total of the change, we can see that positive 50% minus negative minus this 33.33% plus 50% minus 33.33%, and we can see the total percent of change is 33.33% for Fund A. Alright, now we are going to look at the information on Fund B. Alright, if I get back to Fund A, you can see that over these 4 years, that is from the first year to 4 years, we can see that the beginning NAV is 1 ringgit. Same goes to the ending net asset value at the end of the fourth year, also 1 ringgit, which means if we are looking at this information, we can simply jump into conclusion that Fund A actually make no profit, because over the last year, the beginning and the ending net asset value is similar. So as if that is actually zero profit for the Fund A. That is actually by using the simple layman analysis on evaluating the Fund A. Alright, now we are going to look at the Fund B. As for Fund B, the net asset value is 1 ringgit for the first year, but the ending net asset value reduced to 50 cents at the end of the first year, which means there is a reduction of change of 50%. But in the second year, from 50 cent, it increased to 1 ringgit, which means a 100% change or 100% increase of the net asset value of the Fund B. And same goes to the third year and the fourth year, and we can see at the beginning and at the end, the net asset value is basically similar. That is 1 ringgit here and 1 ringgit here. And we can also make a conclusion, a simple conclusion, that by looking at this information, we can see that the net asset value is not changed. So which means that there is this fund is not really make no profit because the net asset value is similar from the first year to the fourth year. But if you look at the change from negative 50% to 100% to negative 50% to 100%, we can see that the percent of change over these 4 years is 100%, while the percent of change for the Fund A is 33.33%. Alright, so if we look at just based on the first year and the final year net asset value, we can simply jump into the conclusion that this Fund A and Fund B are basically not profitable for us. But if we make a further analysis by looking at the performance of Fund A, we can see that Fund A actually, although the beginning net asset is 1 ringgit, this fund actually perform better because it increased to 1.50, which means that at certain point of time, the value of the net asset increased beyond the initial value, that is 1 ringgit. So we can see that it is a good try or good performance of Fund A because at certain point of time, it reached higher value than the original value, that is 1 ringgit. So we can see here in the first year and the third year, it increases to 1.50. Nevertheless, if we use the same analysis to Fund B, we can see that the value is always dropped below the beginning net asset value. You can see that here, the beginning net asset value is 1 ringgit, and in the next several years, we can see that it keep reduced to 0.50. It is not increasing, but it is always below the beginning net asset value. So if we are using the second types of analysis, we can see that Fund A actually perform better because it increases the net asset value at certain point of the period. But for Fund B, it seems that the figures, the net asset value consistently going low, below the beginning net asset value of our original investment in year 1, for example. Alright, so by looking at the analysis of the movement of the Fund A shown ability to grow above its original net asset value by 50%, that is 1.50, but Fund B only ranged from 50 cents to 1 ringgit and never made any progress above the net asset value of 1 ringgit. And it seems that the performance of the past 4 years of Fund B is actually really disappointing. Alright, now we try to make an analysis of Fund A and Fund B using arithmetic rate of return. This is pretty simple, where we have to divide the percent of change with the number of years. So, as for Fund A, we can see that the percent of change is 33.33%. Divide with 4 years, we can see that the arithmetic rate of return for Fund A is 8.33. But for Fund B, we can see that the percent of change for Fund B is 100%. And if we divide it with 4, we can see that for Fund B, 100 divided by 4, we can see that the arithmetic rate of return is 25%. Therefore, although in this analysis we claim that Fund B is less favorable compared to Fund A, but if we look at the arithmetic rate of return, we can see that Fund B is actually perform better, because based on the arithmetic rate of return, Fund B is 25%, which is very high, while Fund A, the arithmetic rate of return is just 8.33%, which is considerably very low. Therefore, between these two funds, if we measure using the arithmetic rate of return, obviously Fund B is much more favorable than Fund A. Although in the previous analysis that we already discussed, we can actually conclude that Fund B is less profitable, is less favorable compared to Fund A. This actually showing you the complexities in selecting the fund and the analysis that you have to perform, the judgment and deliberation that you have to perform before you make a decision on your investment. Alright, so if we look at the calculation using the arithmetic rate of return, the Fund A seems to be lower than Fund B. At this point of time, as a financial analyst, you have to observe the contemporary practice by the fund managers from the unit trust on what actually the basis for them to evaluate the whether Fund A or Fund B is more favorable. Okay, another analysis that you can perform is what we call as geometric mean of return. This is also one way for us to analyze which fund is actually better for our investment. Okay, now we are going to look at the geometric mean of return for us to analyze our investment. And in this situation, there are several situations where the first situation is where we are going to calculate the result under one lump sum investment or single contribution investment. This is one lump sum investment. While in the second situation is where we are going to use dollar cost averaging, where there will be constant payment for each of the period. Okay, so now we are going to look at another example. Okay, if we assume that investor has 40,000, RM 40,000 and invested in one lump sum 4 years ago, the value after 4 years shall be 40,000 provided that there are no initial charges. Okay, if there is an initial charge of 5%, therefore the value will be reduced by 2,000 and ended up to be 38k after 4 years. Okay, which means if there is an initial charge of 5%, the value of 40,000 will be reduced for another 2,000 because of the initial charge that the client have to pay, or the investment has been reduced due to payment of the initial charge of 5%. Okay, so as for the calculation, because it's a one lump sum payment, the amount is, it just happened in 1 year, all right, and the amount invested is 40,000. So at the beginning, net asset value of 1 ringgit, the units acquired will be 40,000. And taking note that if there is an initial charge of 5%, the price will be reduced to by 2,000 to pay for the initial charge. Alright, that is the example under one lump sum investment. Now we look at the example of dollar cost averaging, which means constant payment for each period, where in this situation, like in the one lump sum investment, the 40,000 is paid in the first year only, but in the dollar cost averaging, the amount of the investment is 40,000, but it will be invested in 4 different years, where the amount invested is 10,000 per year. Alright? Therefore, if we look at this table for Fund A, okay, let's say the initial charge is 5% and the amount invested is 10,000 per year, it means that the initial charge is 500 per year, which means the total amount invested for that year, which is 10,000 minus 500, the balance is just 9,500 will be used for the investment. Okay, so by taking Fund A as an example, okay, the one that we have before, the one that we discussed before, alright, on the Fund A, that is on the net asset value changes for Fund A. So as in this dollar cost averaging we applied to Fund A. And if you look at this table, okay, the beginning net asset is 1 to 1.50. This is information from the Fund A, and we can see the change, the percent of change is 33.33%. Amount invested is 10,000 per year for 4 years. And if we consider the initial charges of 5%, for the first year, the amount that we have, okay, the unit that we have is only 9,500 units. Okay, this is the unit acquired. Okay, unit acquired by considering the 5% initial charges. Therefore, the value of the investment, though the value invested is 10,000, after we reduce the 500 of the initial charges based on our calculation here, now the value of the investment is just 9,500, and if we divide with the price at the beginning of the net asset value, that's 1 ringgit, which means the number of unit that we can get is 9,500 unit. Okay, so same goes to the second year, where the investment amount invested is 10,000, but after we reduce the 500, the remaining of the investment is just 9,500, and if we divide with the beginning net asset value of 1.50, the amount of the required, the amount of unit that we acquired, that we can buy, is just 6,333.33. Okay, so same goes to the third year and the fourth year, and we can see as for this column, that is the unit acquired, okay, is just 31.666.67, okay, while the amount invested is 40,000. Okay, so this is some kind of the comparison that we can see. If there is a initial charge of 5%, the units acquired for Fund A is just 31,666, but the amount that we invested is actually 40,000. Alright, now we already understand that this is actually the unit acquired. Okay, so at the end of the fourth year, the unit acquired that we have is 31,666.67, while the amount that we invest is 40,000. Okay, the amount that we invest is 40,000. The number of unit we have is 31,666.67. Alright, how we are going to know whether we are actually making profit or making loss? So we have to check on the fourth year, the ending net asset value is 1 ringgit. So if our unit is 31,666.67 and the price is 1 unit, which means the value of this investment, 31,666.67 unit times with 1 ringgit, which means the value of this investment is 31,666.67, which is much lower than the amount that we invested, because we invested 40,000. Therefore, we can see there is a huge loss when there is an initial charges of 5%. Huge loss. That is the difference between 40,000 to 31,666.67. The difference is about 8,000 something, and it is actually very, very huge. Because if we pay using the lump sum, okay, lump sum, that is 40,000, one lump sum investment, the unit acquired is 40,000 at the beginning NAV of 1 ringgit, considering that will be the situation. Then if, for example, there is a 5% initial charges, our investment will be reduced just by 2,000. Okay, 5% times with 40,000, so just 2,000. But if we look at this Fund A, as if that we are actually making loss up to 8,000 if there is an initial charges of 5%. Okay, now we use the similar situation for Fund B. We calculate the information about the unit acquired. Okay, if there is an initial charges of 5% for Fund B, the amount invested, all of this information are similar to information that we discussed before in Fund B. If you look at the example that I've already shown you before, information about the beginning net asset value of the Fund B, now you can see that the units acquired for Fund B actually very high. That is 57,000 units. Despite of the investment of 40,000 ringgit, the unit acquired is 57,000 units, and if we times with the ending net asset value at the end of the year 4, which means that 57,000 unit times with 1 ringgit, which equivalent to 57,000 ringgit. Okay, so in this example, you can see that by having an investment of 40,000, you can get a return of 57,000 after 4 years. Okay, after make a constant payment of 10,000, 10,000, 10,000, 10,000 for 4 years, all right, using a constant dollar averaging, then you can get this profit from the investment, that is 57,000, which is much higher than your initial investment, that is just 40,000.